The decision to sell a stock can be rather confusing. Do you sell it because it has gone up to secure a profit? Do you sell it because it has gone down, cut your losses short? Or perhaps you should sell it because it has been flatlining while all your friends are getting rich on Bitcoin. Luckily, Warren Buffett, the Oracle of Omaha and the Sage of Securities, has got us covered on this subject. The world's greatest investor has discussed the art of selling during quite a few occasions. In this video, you'll learn 3 practical situations in which it is time to sell your stock market holdings, Warren Buffett style. By the way, if you've only heard what Warren Buffett has had to say on this topic more recently, you are probably doing it wrong. This is the Swedish Investor, bringing you the best tips and tools for reaching financial freedom through stock market investing. Before getting into the 3 situations which should have you sell a stock, let's first discuss why the character in the intro does his selling all wrong. It is because he's focusing too much on what he paid. Buffett says this.
One of the important things in stocks is that the stock does not know that you own it. You have all these feelings about it, and you remember what you paid, you remember who told you about it, all these little things, and it doesn't give a damn. It just sits there, and a stock at 50, somebody's paid 100, they feel terrible, somebody else paid 10, they feel wonderful, all these feelings, and it has no impact whatsoever, and so it's
Okay, so if the fact that a stock has gone up, down, or is just moving sideways shouldn't have any impact whatsoever on your selling decision, then what should? The first situation when Warren Buffett wants to sell is this: when something better shows up.
The first 20 years of investing for me, or maybe more, my decision to sell almost always was based on the fact that I found something else I was dying to buy. I sold stocks at 3 times earnings to buy stocks at 2 times earnings 45 years ago because I was...
You know that I love to talk about opportunity costs. If you put money in the shares of company A, you cannot put that same money in shares of company B. This sometimes makes for tough decisions. You may have to abandon a company that you really like for something which is even more terrific. Here's an example from his 1959 letter to partners in Buffett Partnership Limited, when Buffett switched his position in a bank called Commonwealth Trust into the mapping business of Sanborn Maps. Late in the year, we were successful in finding a special situation where we could become the largest holder at an attractive price, so we sold our block of Commonwealth, obtaining $80 per share. I might mention that the buyer of the stock at $80 can expect to do quite well over the years. However, the relative undervaluation at $80 with an intrinsic value of $135 is quite different from a price of $50 with an intrinsic value of $125, and it seemed to me that our capital could be better employed in the situation which replaced it. Here's where you may have gone wrong with your selling if you've listened to the more recent advice from Warren Buffett. Today, he wouldn't sell his wholly owned businesses even if he expects them to deliver subpar investment returns. It is a little bit misleading to listen to the advice that Warren Buffett's favorite holding period is forever. Holding forever is just a personal preference of his these days. He prioritizes the personal relationships he's been able to build up with the managers of the subsidiaries at Berkshire Hathaway more than making a few extra percentages of returns.
And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me.
The Berkshire Hathaway Owner's Manual was first presented in an annual shareholder letter to the Berkshire shareholders back in 1983. But this thinking of Buffett's goes further back than that. Have a look at what he said in a partnership letter from 1968. As I have mentioned before, we cannot make the same sort of money out of permanent ownership of controlled businesses that can be made from buying and reselling such businesses, or from skilled investments in marketable securities. Nevertheless, they offer a pleasant long-term form of activity when conducted in conjunction with high-grade able people at satisfactory rates of return. Buffett's preference for reselling businesses started to change after an experience with Dempster Mill Manufacturing in the early 1960s. A whole town pretty much hated Buffett for buying their largest employer and then slashing down costs and jobs in order to make it profitable for a sell. However, if we look at his partnership letter from 1961, when he also operated with less capital, we'll see what I suspect that Buffett would suggest us smaller investors to do. Our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected.
It's not personal, Sonny. It's strictly business.
Another situation in which Warren Buffett would sell a stock is this: when the economic characteristics of a business change in a major way.
Our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. And that happens.
Let's look at a few examples of major changes which have caused Warren Buffett to sell historically. Just recently, in 2020, he sold his stake in a few of the major airline companies, noting that the world has changed for airlines due to the coronavirus. In 2014, Buffett sold off one of his most important investments of all time, the newspaper The Washington Post. During many years, Buffett talked about how the world had changed for the newspapers, and that the Post didn't possess nearly the same competitive advantages as when Berkshire purchased it in 1973. Finally, he decided to cut it loose. Then there's Buffett's investment in the grocery chain Tesco. Buffett doesn't specify why, but he had an issue with the management of the company, which was the reason for him selling his piece of the business in the end. He was out of the position by 2014, realizing a small net loss. On a more personal note, one of my own worst investing selling mistakes could perhaps have been avoided had I known about this a few years ago. I used to own a Swedish beverage company called Kopparbergs, which had more than half of its revenues in Great Britain. In July 2016, Britain voted to leave the European Union, complicating trade with other EU countries. One could argue that I should have sold back then, instead of, much later.
It's done.
However, I may mention this: fundamental changes happen quite rarely. In his annual report to Berkshire Hathaway shareholders from 1997, Buffett hints this when he says that selling fine businesses on scary news is usually a bad decision. Finally, Buffett is all for a concentrated portfolio, and you know that I am too. But a situation when you must also sell, or cut down, is this: when a single holding gets too big. Yes, the age-old advice of not putting all your eggs in one basket is true, but you don't have to be as strict as most people suggest. The smaller your portfolio is, the more you can afford to put in a single stock. Consider that Warren Buffett had 40% of his partnership's money in American Express in 1967, when he was managing more than today's equivalent of $500 million. The stock eventually took him over his 40% limit rule, and he cut down on his position to maintain some sort of diversification. By the way, American Express is just the fourth largest commitment that Warren Buffett has ever made. Again, the person in the intro of this video is wrong because he focuses on the purchase price. A stock doesn't give a damn what you paid for it! A useful question to ask is the following: if I didn't already own the stock, would I still want to make the investment today? If not, then you should probably sell. Wanting to keep a stock and wanting to buy more of it are not the exact same thing, but they are closely related. They are not the same because selling a stock to buy something else is associated with having to pay taxes on your profits, and additionally, it will incur transaction costs. Therefore, there's a small gap between the buy more zone and the sell zone. This could be called the do nothing zone, a highly underestimated zone in today's world of investing. Sell a stock if you've found something better, if something fundamental has changed, or if a single holding gets too large. Now you know the selling part. If you want to know what Warren Buffett is looking for when he is buying a stock, here's a long video with lots of meat for you. Here, you'll learn about the 25 most important investments of Warren Buffett of all time. You'll learn what these investments looked like at the time of purchase. Cheers guys! Hope to see you again real soon.